What's up, Outliers? Thanks for hanging in there for a few minutes. I was running a test in Jupyter Python technically, that I want to use in the conversation today. So I have a bunch of data points that we'll talk about. I'm going to actually pull the notebook over and we'll take a look at some of that together in a little bit. But what I want to talk about is specifically this general hope for achieving big returns and taking little risk. Sounds great in theory. In the practical sense of things, it's a terrible way to do business. And I want to talk about this delicate relationship. People fear the downside, and this is a deep-rooted psychological function. This is something that is quite literally hardwired into your brain. And it goes back to the time when we were fucking cave men and women. And here's why. If I'm a caveman and I got a nice stick for beating things down, maybe get like some spikes on it, and I'm eyeballing something that I'm expecting to go smash with this, I make a risk assessment. Let's say that I have over here a really dope cave with a bunch of stuff in it. So let's say that I got like meat hanging, air drying from a rack that I made that's inside a smoker. And I have a decision to make. I need to leave this and to take my cool stick in order to go find a critter. Let's call it some sort of whatever this thing has that apparently has elf feet. And I'm looking for some sort of critter. We'll probably have a snout. I don't really know what that face is. It'll have antlers, though. This isn't a dog, to be clear. I love dogs. We'll give it like a little short tail. And if I want to go leave my cave and murder this thing so that then I can bring it back into my cave and then add it to my stockpile, there is a risk assessment going on. And here's what it is. One, when I leave the cave, whatever I have in the cave is now at risk, because there could be some lazy hunchback motherfucker that can't even stand up straight, kind of like the Notre Dame, got a hunchback like this and little tiny arms because he sucks. And this little guy could see my cave is open. And when I'm out here murdering this thing to bring it back to eat, this guy can sneak into my cave and grab my food. That's one risk. The other risk is, as I'm sneaking up on said animal here, it could easily pick up one of its legs and Judy kick me right in the face like this. Pow. It hit me right in the face. And it could break my jaw, causing great bodily injury and maybe the inability to hunt for some time and potentially death as a result. So then I'm left with a choice. Do I want to pursue this, or do I want to protect what I have? More often than not, if you have a decent amount of stuff that you want to protect, you become more cautious to protect what you have versus going to get more. And here's why. If I go kill this thing, bring it back to my cave, I now have even more food. Awesome. That's a benefit. However, if I go attempt to kill this thing and either or both of those things happen, and let's say that my food is stolen, so all my food is gone because the hunchback stole it and he's real quick, even though he can't stand up straight, I've now risked a lot in order to gain a little bit extra compared to what I have. And the bigger risk that I have is if I don't have this, this now puts me below a key line. So up here we have survival. And then down here we have death. Potentially a slow death, which kind of sucks. And then up here we have surplus. If we're at this base level and we're risking something in order to get to a surplus, we as humans don't look at this risk the same. So let's say that we're risking one thing to make one thing. So let's say that there's one animal's worth of meat in here. So I'm going to get one animal and I'm risking one animal. But if I lose the animal that I have, it moves me from survival into the slow death bucket. Versus if I gain that one animal, it puts me in the surplus bucket. So even though the risk relationship here is 1-to-1, the impact on my life is not 1-to-1. This is literally hardwired into your fucking brain. It is part of what we are as people. And it's really important to understand this because our brains struggle to understand that most of the time we're actually in surplus, looking to move to like double surplus. So a potential move down one rung doesn't necessarily put us at jeopardy of anything catastrophic, maybe discomfort, maybe a little less spending money to go out or whatever, but it doesn't move us into the category of death, although your brain doesn't necessarily know that. And the way that you perceive risk is generally in this context here, these buckets. So how does this caveman pertain and relate to what we're going to talk about in terms of trading and hedging? It's important for you to understand our psychological underpinnings. And again, everybody's unique. Some people fall on different ends of the spectrum. Some people are literally fucking psychotic and don't have any sense of this. There's always a spectrum, but most have this artifact. So then the way that you think about trading in markets actually resembles a lot of this. And I'll give you now a non-caveman example, although I personally like the caveman example. I thought that drawing was right on fleek, but that's just me admiring my work. Instead, I want to talk about a trader now. So now we have one of our favorite traders that you all are familiar with. They have really, really long legs, and they have a tiny little body, and then a tiny little head, and they have a big, oh wait, hold on. They have a big gold chain with massive diamond on it. Like this, and it sparkles and shit. So we have our trader, and this trader is operating an account, and let's say that this account has $100,000. Here is our $100,000 account. And we start putting on trades. And one of the things that they hear is you gotta, religiously protect your risk. You gotta be really, really careful with your risk. And it's not wrong. In the beginning, it's not wrong at all. The problem is people end up taking their risk mitigation at times too far. Now, I want to be very clear. I'm highlighting a subset of the population because there is a non-trivial, a large number of newer traders that do not treat risk with enough respect, and they blow up. They go away. I'm not talking about them in this context. This video is about hedging. Those are the people that are not hedging. Those are the people that are YOLOing. That's a whole other bag. In this concept of hedging, we have a trader first that tries to diversify their portfolio. So they're told that you're not supposed to put much of your portfolio in any one individual trade. So they end up with 100 trades on. And the reason why they end up with 100 trades on is because they're trying to decrease how much risk is any one individual trade. And then of these 100 trades that are on, they're now hedging a bunch of them. So let's say 85% of them have some sort of hedge included. This type of risk aversion will quite literally destroy any potential you have at reasonable returns. The first thing you need to do in your analysis of yourself and your portfolio objectives is determine what kind of risk are you comfortable with in your portfolio and what kind of volatility are you okay with in your portfolio. An anecdote. Working with my community, the Outlier community, I've spent a lot of time chatting with different people with different backgrounds, and I tend to notice a really common theme. The common theme is people really want, not surprisingly, the best of both worlds. So for example, I will come across people that say, I want to earn 30%, but I want no more than a 15% MDD, max drawdown. Good fucking luck. Not suggesting it's impossible. That's hard. There's a relationship between risk and reward, but it's not linear. So that means that you can stack things slightly in your favor, but you also cannot defy financial markets and general efficiency. If it was even remotely simple to return something like 30% with a 15% max drawdown, who wouldn't do that? And more importantly, who wouldn't leverage the fuck out of that? Why then wouldn't I double that and get a 60% return with a 30% drawdown? Why wouldn't I do that? And so on. And again, not suggesting that that's impossible to do. That's certainly possible. You can absolutely do that in a year, 2 years, 3 years. You could do that on average for a little while. Who knows? But when you think of trading as a longer term operation, having realistic goals that's your foundation. That's where you're starting from. And that's what you got to start with. You have to decide for yourself what kind of volatility in terms of your portfolio value are you willing to endure in order to hit whatever return potential that you want. That sets the foundation for everything else that you're going to talk about. So that's one general concept outlined. I want to talk about another one quickly. And this one has to do with getting context around markets. So what I have here is, and I haven't gone through this too far in detail, and I literally just finished writing the script for it. So there might be some gremlins in here. So I don't want to take this too literally, but I do want to show you in general some of the stuff to keep in mind. And again, I'll kind of let you know as I go through it how accurate I think it is. But I think people grossly overstate the propensity for downside moves. And it's because they're scary. They're scary to people because most people trade long, primarily long, if not long only. So the downside is where their risk is. The fear there is fair. And it's also because when the market goes down, it tends to go down fairly precipitously. And then when the market goes up, it can go up quickly, but it typically is more of a kind of grind up. So what that means is, in that kind of broader context, markets tend to crash down. So the way that people will put it in like another what the fuck is it called? Analogy is markets take the elevator down and the stairs up, which is pretty fair. We can see that if we look at a longer term window here. And let's go to 10 years. When we see these big down periods, take a look at the size of this down candle. Now, again, this is over the course of a month, but take a look at the kind of ground that was covered there. And take a look at the size of the candle here and the kind of ground that was covered here. And then take a look at the size of these up candles and the commensurate size covered here. This is really, really normal. Take a look at all of these candles over here. Those are all up candles. Those are all entire months, but they're not necessarily blowing anybody doors off. But then if you take a look at these two candles, they're pretty big. So what I'm emphasizing here is that general point. When the markets go down, they definitely tend to gain velocity, which increases fear. The problem with that fear in general, let me zoom out further, is if we look at SPY from 1993 to present, there is a very clear trend to me. And it's not just that it goes up. Clearly it goes up. But it's that it tends to go up. More often than not, it's going up. That matters a lot because a lot of people will over-configure their portfolio for the infrequent excursion to the downside, and that kind of spits in the face of what the market typically is doing, which is going up. That, again, does not mean we don't plan for the downside. You have to. But what I want to emphasize on that point is that you do not want to overemphasize and over-configure your portfolio for the downside. And it's because the market is going to spend most of its time going up. And if you have a different thesis than that, then cool. Then it makes complete sense to do whatever you think aligns with your broader thesis. Let's say that if you're typically more of a contrarian and you're perpetually waiting for the big drop, that's fine, right? You can build whatever makes sense to you. But from a statistical lens, we can also measure things. And again, just from a couple quick views here, we can clearly see that in general, this thing goes up. So to summarize that point and the main takeaway for you guys, we have to be thoughtful of the downside. You have to be aware that you have baked into your brain a psychological underpinning that makes you more sensitive to loss than gains in general. Again, there's always a spectrum, but in general. And when we're configuring and building our portfolio, we have to start with what our expectations are, make sure we have reasonable expectations of upside targets, and what kind of downside volatility are we willing to absorb to get there. Then, after that, we have to then determine how we want to set up our portfolio. The way that we begin this process of setting up the portfolio is first by acknowledging the space that we're operating in some of these summary statistics here. So the market itself tends to spend, as you could tell, the overwhelming majority of its time within 5 and 10% of all-time highs. What this plot is showing you is how far is this thing below its all-time highs at different periods. And then it shows you how long does it spend there. And then we can actually look at things like distributions and the frequency of us being at these points. And this kind of summarizes it into something that's a little easier to consume, which is, again, here, the market spends the majority of its time within 5% of all-time highs. As we get further and further out, obviously, we are going to capture more and more of the total sample size. And then obviously the deviation between these, 12%, is kind of where it falls in between these in kind of this example here. So the takeaway from this quick overview of some basic summary stats is that it's not my opinion. It's not really what I generally think, but it's unequivocally the fact that the market spends the majority of its time near highs. And then more importantly, we can look at what the forward returns are based on our distance from all-time highs. And you can see that as we get further off of all-time highs, our bands open up in terms of the extremes to the upside and to the downside, which is an important point, because then if we actually look at what the average is or what the median is, it's still positive. So all of this bubbles down to markets tend to go up. And that general point is really important to keep in mind as you build your portfolio. If you overemphasize and overbuild to the downside, then you're kind of setting yourself up for swimming upstream perpetually, which, again, do whatever you want. It's just a harder way to make money. Steve says, pretty cool chart stats. Yeah, I'm glad you enjoyed them. The thing is, as you guys know, I come from a stats background, and I try to use stats as a lens for me to interpret the world around me. And it helps me contextualize a lot of stuff. And this is also why, for people that are familiar with the way that I configure my portfolio and whatnot, it's why the core allocation is typically long market beta in some capacity. Literally because of that, market tends to go up. Plus, most of the stuff that I'm long market beta in kind of combine a little bit of the momentum factor, like the S&P 500, NASDAQ, they, shed the losers, buy winners, which is a momentum factor baked in, cross-sectional momentum factor. So let's now double back, and I want to talk about hedging and some of the common regrets. And there are regrets from hedging. The first thing to keep in mind, and I have an entire video, I have multiple videos on managing risk in a portfolio. I'm not going to go super deep into detail there, but I just want to gloss over a few important things first. The way that I look at hedging, there's kind of two distinct levels. There's like portfolio level, there, I guess maybe three. There's kind of strategy level, and then there's trade level. In general, I really am focusing on these two. Strategy sometimes comes online. I think it's completely fair to just focus on portfolio level and trade level hedging. And then within this space, there's two types of hedges that I generally consider. There's a direct hedge, and then there's an indirect hedge or an opportunistic hedge. An example of these is, first, let's say that I look at my aggregate portfolio level details. Let's say that I find myself too long beta weighted SPYs and I want to trim some of those off. So I sell some calls in SPY, or I buy some puts in SPY, or I buy some calls in VIX, or whatever else makes you happy, effectively adding short deltas to short beta weighted deltas to at the portfolio level. That's at the portfolio level. This is when we look at a basket of a bunch of individual things. We look at what it aggregates to, and then we come up with our hedge at that aggregated level. And then the individual trade level is exactly what it sounds like. We take one of these out and we say, on this one individual trade, I want downside risk, but I don't want too much downside risk. And there's different ways you can set up these kinds of hedges. You can either just indirectly hedge it by maybe picking a lower delta or whatever, or you can directly hedge it by adding a wing or something like that. And this idea of direct and indirect is kind of what it sounds like. In a direct hedge, the entire purpose of the position, the hedge that's going on, is to lose. I want it to lose. The reason why I want the hedge to lose is because it means the base idea is winning, and that's really what I want. So the purpose of a direct hedge in general is to prevent some sort of catastrophic loss or something that, like a massive shock to the portfolio. In general, this is expensive. This is really expensive to do. This is something that I do very sparingly. Then indirect hedge. This becomes a lot more accessible. And I have different examples of this literally going on right now in the portfolio. So for example, right now in my portfolio, I have the covered strangle in TQs, which is a 3 times levered index ETF attached to Qs, NASDAQ. So this is long beta. We're long beta. And I have a view, multiple views on what's going on in the world today and ideas from that. And one of them has to do with crude oil. What I can do is look at the relationship between Qs and crude. And right now, the idea that I have in crude is based solely on crude. I don't really care about the relationship it has with TQs right out of the gate. I'm focused on the individual opportunity that I see in crude. However, when I analyze the relationship between these, I notice that it actually lays off some of the risk here. It's an indirect hedge. It's something that I'm trading a specific opportunity here that happens to help offset some of the risk here. So as the market's going up, at least as of late, then crude might go sideways, flat, even down. It could be uncorrelated depending on the time frame that we're looking at. But then if the market's going down and crude is going up, it's kind of providing, again, a little bit of a layoff of that risk. That's an indirect hedge. This is really what I would consider to be the primary place for traders to look for risk mitigation. The way that you build indirect hedges is pretty simple, right? There are things like sizing things appropriately, having a mix of expirations, having a mix of deltas, meaning long and short beta weighted deltas just to normalize it to something, being long and short gamma, having stuff that's long and short theta as a result, and so on. And the way that I think about aligning the portfolio level risk to whatever my assessment is I'm just going to lean all of these metrics to align with whatever my broad assumption is. That's all I'm doing. That's a quick overview of hedging and risk management. Again, I have several videos on the channel. I'll find a couple of them really quick for you, but I want to pause here really fast and see if you guys have any questions on this idea of hedging, what these different kind of methodologies are, portfolio level hedge, trade level hedge, direct, indirect, any stuff there that you want to double click into that would help you, please let me know. And we will talk about it. And then in the meantime, I'm going to drop a couple videos in here. Hey, yo, what's up, Tom? Good to see you. Let me drop a couple videos in here that talk about risk management there. And then beta weighted deltas here. These are all these videos that I'm linking in right now are about risk management. This is about risk management, and that should be good enough. I think that's plenty. Steve says, how do you decide how long you have the hedge on? Like 1 month put at the money on underlying? Well, the way to determine the duration for the hedge is, again, to clearly define the purpose of it. If it's a portfolio level hedge, I'm literally going to define the period of time that I think I need to have protection on for the broad portfolio. If it's a trade level hedge, it's the same exact thing. So for example, if I'm holding a stock and it has earnings coming up and I really don't want to be exposed to earnings, I'm going to hedge and I'm going to pick something that allows me to lay off the risk that I want to lay off, but really just to get me through earnings. I don't necessarily want to have leaps in, leaps puts for my hedge. I want something shorter term than that. So the easiest way to think of it is to just clearly define why the hedge is on. And if you find yourself doing that and you're like, well, I kind of always want to hedge, again, that's a problem. It means if you feel like you always need to have a hedge, you're probably oversized. Because again, the only real reason to lay on direct hedges, which we know are expensive and we know add drag to our returns, and if we can't lay off that risk through all of these other tools we have available, sizing smartly, spreading across expirations, having a mix of deltas, all that kind of stuff, and we still have aggregate too much risk and we're not missized, then that probably means we need to take a look at some other strategies. It probably means that we're really, really constrained in what we're putting on. And that might be your modality. That might be your approach. And again, that's okay. If, let's say, for example, you're a long only trader, that's okay. But then it does require being really thoughtful on how you do that, because then you can still be long non-correlated underlyings or inversely correlated underlyings and stuff like that. The simplest way to think about how long to have a hedge on is to clearly define why the hedge is there and then pick something that's relevant to that time frame. That's it. There's really no magic to it. But one of the absolute diseases that traders have when it comes to hedging that is absolutely worth mentioning is whenever you put on a hedge, you should absolutely be mentally expecting for that trade to lose. If you are going into a hedge with the idea that you are going to somehow make money on your hedge and money on your trade, you are a kook. Like, you're completely tilted in the way that you analyze that. And the common representation of this is when somebody says like, oh, well, I'll put on a hedge and then I'll take the hedge off when it's profitable and hold, the core position until it becomes profitable. Here's the problem with that. When the hedge is profitable, that's when the fuck you need it on. That's when it needs to be there. So then as soon as you take off your hedge when it's profitable, that's literally the bad time for the base trade that you have on that you originally put the fucking hedge on for. So to take the hedge off at that point quite literally makes zero sense. Hedges, by general approach, should be viewed as drag. Now, let's talk a little bit about some of the common ways that traders will hedge and some of the subsequent regret that follows typically shortly thereafter. The first I want to look at is a portfolio level hedge example. And let's take a look in SPY. The way that you build a hedge needs to be really well thought out. And I'll show you why. Let's say, for example, that you thought there was going to be this big drop coming up. And let's say that you identified this. You thought you had the tea leaves, the writing on the wall. And let's go to something that's a little bit more extreme. I want something that gives us like a decent move here. Let's say that you knew that this was going to happen, that there was going to be this conflict in Iran. And let's say that you knew that back here. Let's say that you got in back here. And let's go to 7 December of 23. And let's go into on demand and let's go put on a hedge real quick. And I want to show you how this thing actually behaves. We got to go to 23 December 7th here. And we'll go towards the end of the day. And let's let that load up. And so here I forgot what are the people that read the future? Not a fortune teller. What are the fucking, I forgot the name of those people. There's people that, I forgot the name of them, but there's like a term for them. The people that think they can read the future and shit. And you're one of those. And you're expecting some sort of big drop at some point in the future. So what you do is, Steve says psychic. That's not that definitely applies. That's not the one that I'm thinking of. There's like a specific term for people that think they can like see the future. I'm going to look it up. What is the prophet? What is the term for people that think they can see the future? Fucking term. I'm asking Grok. Clairvoyant. Bam. That's what I'm going for. Clairvoyant. If you're clairvoyant and you knew that this thing was going to happen, and let's say that you go really far out in time and you're like, okay, I'm going to buy some of these 50 Delta puts, and let's say that I'm going to buy 5 of them, whatever. and I'm going to get them for 28.79, 400 days out. My daily theta is really, really light, and this is going to provide me some decent crash protection. Cool. Let's fast forward now. Let's come to 26, and let's go to the beginning of February 1st. Oh, did we go too far? When did these? Oh, these expire in 25. That's my bad. That's my bad. That's my bad. This is fine. We can still go to 25. And let's go, when did these expire? In January. So we'll go to like November of 25. This is still fine. There's a really nefarious thing that happens with buying some sort of really long-term puts as your protection. And it's this thing that I'm showing you right here. Notice how we bought originally a 50 delta, which were the 470s. These are now literally a 0.06 delta. So what's happening here? Your direct hedge that you thought you were being smart because you expected some sort of drop in the next 6 months to a year, but you're not really sure when. So then you opted to go far out in time by going into leaps. You know that you're decreasing your daily theta. You know that you're decreasing your overall gamma. So in general, you're like, this is okay. I'm not really necessarily looking for some sort of massive compounding feature here. I mostly want to play the deltas on this, and you're using leaps to do that. That's fine. But going back to what we talked about in the beginning and some of those stats that I showed you, the market spends most of its time going up. So the issue here is your deductible is going to continue grinding higher as the market goes higher. So for example, if we have a price plot and S&P is doing this and you buy your puts here, you get your long puts right here. Right now, your deductible is whatever it is. And the way to think about your deductible is how far does the underlying go down before you start getting paid out on these puts. So let's say if the market drops 5% right now, your deductible kicks in and you're now making money net, or you're at least offsetting a decent amount of the portfolio, whatever. Fine. But as the market grinds higher, now your deductible up here is, let's say it's 25%. So there's all of these unrealized or realized profits that occur over this window. And this long put, originally expected with a 5% deductible, now is a 25% deductible. That means you got to withstand a 25% drop in the underlying before the thing really comes online and helps you. So how do you fix this? Well, you have to rebalance it pretty regularly. So as the market is grinding higher, what that means is you're going to buy to open it for $1, then you're going to sell to close it for 60 cents, and then you're going to move it up, and then you're going to regain sensitivity to that 50 delta or whatever. And you're going to do this over and over and over again. This is the carrying cost for that hedge. This doesn't go into the litany of details of put premium, put skew, all of those kinds of things, how you're also systematically overpaying for this thing. So this is just one example where somebody can put on a hedge, and then when they think the hedge is going to work or help them, if the market had drifted up in that time frame, they now actually have to wait longer in order for something to happen. And that normally leads to people being upset, because then you either give up more of the profits on the underlying than you wanted to, or you realize that that hedge is actually more expensive than you thought it was going to be, and now you have to move it anyways, and so on and so forth. That's one easy way to regret putting on your hedge, is by not carefully thinking through what kind of risk you're attempting to offset over what tenor, and most importantly, what deductible you're comfortable with, and how that is going to evolve as the underlying moves in both directions, not just against you. But again, remember, ideally, you want it to be against you, because if this thing is doing poorly, if your hedge is losing, it means the rest of your portfolio is doing what you want. Your hedge should lose. You want it to lose. Now, another quick admin note without going too deep into hedging. Again, highly recommend checking out those other videos that will go much more into detail than this. But you have to figure out how much of your portfolio and stuff that you want to hedge. Because one of the things that I think people systematically do and subsequently regret is overhedging. Let's say that you're currently long beta weighted deltas. Let's say that you're plus 500. And let's say that you think this is too long. You don't want to take some of your trades down because of taxes or whatever reason. So you want to leave them on. And let's say that you introduce some short deltas, again, via long puts or something. And let's say that you introduce minus 300 deltas. So as the underlying or as the things go up, you are now adding essentially 300 deltas of friction. That's also going to do something really important, again, unless you're doing like some sort of synthetic short or whatever, which is compound. So as this thing goes up, this is going to slow your P&L down, and these are actually going to unwind. So as it goes up, you go from 300 short deltas, and now you have 200 short deltas, and so on. You actually bleed off deltas. And then as the underlying or as the market starts doing what the hedge is there for, and let's say that it starts trickling down. Well, let's say that you bought a 5 lot. You bought to open 5 of these puts, but you only had 300 deltas to start. Well, what this means is you have a maximum of 500 deltas. So these are going to gain as the underlying goes down, adding more protection on the way down. That's a good thing. The rub there is you have to have an idea on how you intend to manage those puts, the hedge, because there has to be a relationship between the underlying and the hedge. So for example, like I said before, if down here you're like, okay, I want to realize the P&L on these puts, they're doing awesome. Yeah, you could do that. You could take those off. But now the hedge that you put on from the beginning is no longer there. So then if this thing continues down, well, now you're completely exposed. That wasn't the original plan unless something changed. So you have to have a really good plan on how you intend to manage your hedge so that you can strike that balance between protecting the underlying asset or assets that you put the position on for with logical profit and loss taking of your hedge. Very frequently, people will take the hedge off prematurely because they want to realize the P&L, and they subsequently regret it when the underlying continues in the negative direction and they still have their base position on. Really, really common problem. An easy way to think about this is not the way that I would approach it forthwith, but it is a good starting point, is just kind of think of these as a pairs trade. So if your hedge comes off for whatever reason, you should be taking some of the base position off for whatever reason. I would think of them a little bit more as a pairs trade. Now, again, you don't have to be that rigid longer term. You can definitely explore the space a little bit and some of the gray area that definitely exists to be a little bit more efficient. But in the beginning, I think that's a good starting point so that you're not making rookie mistakes like this. It just doesn't make sense. And there's one last one that I want to talk about that's really, really common and really, really painful for people. And I think a lot of you will actually identify with this one. As I go through this last example, if you guys have any specific questions or anything that you want to hit, now's the perfect time to start throwing those in the chat. Let's say that you want to be long Tesla. Just picking something. That kind of moves too much. Maybe we'll do NVIDIA. Let's say that you want to be long NVIDIA. And let's go back 3 years. And let's say that you got in here, 28th of May of last year. Let's go there. Doesn't really matter. Okay. You decide that you want to go long NVIDIA. And you have shares. Let's say that you buy 500 shares. You get your shares out, and then you say, well, I want a hedge and I want to collect a premium. So to get that hedge, I'm going to sell calls. I'm going to sell calls somewhere where I don't think I'm going to be assigned, maybe this 147. And I'm going to sell 5 of them because I have 500 shares. And I'm going to collect $2.90. I'm actually going to make a decent amount of money here. This is awesome. The first thing is this hedge isn't that great. This hedge will help you on small down moves that you otherwise probably wouldn't care about anyways. And if you have larger down moves, it doesn't really do anything for you. You still have uncapped risk to the downside. So the first thing to pay attention to is like the overall risk outlay from this is not significant. So for example here, if you get a 10% down move, you're going to be at $5,400 loss versus without is 68. So $1,400 more. Again, there's definitely an outlay. It's just not that much. And as the underlying moves further and further against you, that outlay is going to get closer and closer. So for example, at a 15% drop, you're at an $8,800 loss versus 10.2. That's the first thing, is the actual risk outlay from a covered call really is not that much. More importantly is what you end up sacrificing to the upside in bigger moves. So let's add a couple more nodes here. And let's say that the underlying starts to move aggressively in your favor. So let's say it goes up 25%, and then let's say that you have a better quarter and it goes up 35%. If you have the short call on, you are going to be capped. Now, these aren't correct because these, where is this putting us? Yeah. Essentially what would happen is as soon as you get above, what's our strike? 147. So as soon as you get above 147, you're immediately capped. So this thing, I think, is just because we're back in time. Let me see if I can get us here. So this is May 31. Wait, is that where we're at? May 28. There we go. There we go. Now we have real numbers. Ah, perfect. And even better. So let's get real numbers now. If we get that 5% drop, which is here, without the short calls, you're going to lose 34. And with the short calls, you're going to lose 26. So you save yourself about, what, $800 on a 5% drop. On a 10% drop, you go from 68.30 without to 5,600. And then a 10% drop, you go from 10.2 to 88. So there's absolutely risk mitigation there, bar none. But the equation is not balanced, because let's take a look and let's actually track these really quick. We're going to do minus 5%, minus 10%, minus 15%, or I think it just does like what? 5, 10, 15, that's fine. And then we'll do the opposite. 0. And then we'll do 5%, 10%, shit, and 15. And then this one will be stock only. And then this will be covered call. And we're just going to look at the relationship here. And I'll plot these down really quick so that it's easier. 10,245, 68.30, 34,150, negative 68.30, negative, oh fuck. Pretty fucked up. Negative Something doesn't seem right here with these numbers, but whatever. It's more for the comparison. They shouldn't be this matched. Oh, duh. I'm in stock only. I'm a fucking retard. Yeah, those look absolutely correct. That's my bad. 48.73. 37. '50s. Okay. Let's take a look at what's happening here. What I want to do is just compare the difference between these. So we're going to look at the covered call loss compared to the stock loss. And let's just look at this up. What do you see here? You should see a really, really important trend. You should see that if the underlying goes down 5%, you save yourself $781. If the underlying goes up 5%, you're giving up $1,300. What's going on here is what you save yourself to the downside is quite trivial compared to what you're giving up to the upside. And this is exactly why covered calls in general are a terrible hedge. That doesn't mean that you shouldn't trade covered calls. There's also, as you guys know, ways to trade them at a ratio and whatnot. The main thing that I'm pointing out here is to trade covered calls for the purpose of a hedge is not really going to do it for you. If you're doing it for other reasons to bring in short theta to the position and whatever else suits your fancy, totally cool. It's a completely different story. But if you're going into this saying, I'm going to use this to reduce my risk, the problem with that is what you get from a risk reduction is not commensurate anywhere near with what you're giving up if the thing actually does what you want it to do. AKA, you sell the calls, it moves up, and then you have regrets. Lots of them. That one's super common. That one happens literally all the time. You'll see it all over the place, specifically on like Reddit and whatnot. So that is a general overview of hedging in a nutshell. And then more specifically, some of the spots where people slip up and have pretty significant regrets regarding their hedging decision. I would summarize that up to there's nothing wrong with hedging, but it needs to be very selectively done. If you just are risk averse and you just don't like drawdowns and you just don't want risk, that's okay. But that's what bonds are for. That's what other asset classes are for that reduce volatility. If you find yourself constantly trying to hedge stuff, that also means in general, you're probably sized too big. Just size the fuck down and do yourself a favor and remove the rest of the shit that you're overlaying so that you actually have a chance to make some fucking money. Because for all the people that go out there and they sell these calls to reduce their downside risk, they're reducing $1,000 of downside risk and giving up 3,000 to 5,000 plus, which is not a great risk to reward ratio. And if you look at that and you're like, well, you know, I still make money to the upside. Yeah, you still definitely would make money to the upside. But the game that you're playing with this kind of structure is you are quite literally bearing all of the downside risk and then capping your fucking upside, which is the compensation for the downside risk. It doesn't make sense. So a big part of all of this is just getting comfortable with taking risk. If you are an operator in the stock market, an individual operator, you take risk. It's how we make money. Then you can diversify your risk in some of the ways that we discussed earlier. But stuff like this, generally gives you the worst of both worlds. You're not getting much risk reduction, and you certainly are capping the living shit out of your profit potential. Literally worse on both sides. So that's what I got. As always, if you guys need anything, you can hit me up in the Discord, be an outlier. See you guys later.